Hello, good morning, and welcome to this IFS webinar this morning. I'm Paul Johnson, I'm Director of the IFS, and it's my pleasure to welcome you to what must be something like our 30th annual presentation on what's happening to living standards, poverty and inequality in the UK. This is our annual update, and for once over recent months, this is not going to be focused specifically on what's happening right now in the period of the coronavirus. This is looking at data going up to last year and really setting the scene for what's happening at the moment, looking at what's been happening to living standards over the last decade and more, obviously drawing some conclusions for what's happening today. But for once, we're not just going to be focusing on the last 2 or 3 months. As I said, this is something we've been doing annually for something like 30 years now. We're very grateful to the Joseph Rowntree Foundation in particular for funding this analysis, which they've been doing for some considerable period of time. And we've now built up, I think, an unrivaled set of data, information and expertise on what has been happening to income and living standards over a very long period. There's going to be 2 presentations this morning. First from Pascal Bourquin, who is going to be looking particularly at what has been happening over the last few years to average incomes and to inequality and to poverty. And then Tom Waters will take a deep dive to look at what's been happening in the labour market, what's been happening to the numbers of jobs and to pay and to the quality of jobs over that period, and what the labour market has looked like as we've moved into the last few months. With no further ado, I'm now going to hand over to Pascal, who will talk for 12 minutes or so. Tom will speak for a similar period, and then there will be plenty of time for questions. And if you do have a question, please email it to events@ifs.org.uk. That's events@ifs.org.uk. And it'd be helpful if you could start emailing those questions whilst the speakers are speaking, so that we have 1 or 2 to get our teeth into straight away afterwards, but then carry on emailing them in once the Pascal and Tom have finished. So right now I will hand over to Pascal. I'll be back in 20 minutes or so when Pascal and Tom have finished.
Thanks, Paul. So I'm going to be talking about living standards, inequality and poverty in the UK, as Paul mentioned. And this is joint work together with Robert Joyce and Agnes Norris-Keeler at the IFS. So I'm going to be talking a lot about household incomes in this presentation. So let me quickly explain how we measure income. So we measure income at the household level, and we measure it net of direct taxes and benefits. Furthermore, we adjust household income to account for differences in family size and structure. And this is because families of different sizes and structure will require a different amount of household income in order to attain a specific degree of living standards. We have 2 measures of household income that we're going to use, one before housing costs have been deducted and one after housing costs have been deducted. So here I'm showing you median BHC income since 2002, that's before housing costs have been deducted. And what we see is that in the period leading up to the recession, median income was growing at around 1.2% per year. In the immediate aftermath of the financial crisis, median income then fell at 0.6% per year. However, it recovered at quite a reasonable rate of 1.6% per year from 2011 up until 2016, which is actually higher than what we saw in the period leading up to the recession, but lower than the historical average of around 2%. Now, just a quick reminder that we're looking at the period before the coronavirus pandemic hit, as Paul said. So over these last 2 years of the data, median income actually completely stalled. And that means that median income in 2018 was actually at the same level it was 3 years ago in 2015. And this can be largely explained by relatively high inflation, partly due to the depreciation of the sterling after the Brexit referendum. Now, this kind of poor growth in income is really more worrisome or disappointing if we think about what's about to come. We think the coronavirus pandemic is really likely to pull down household incomes as workers lose their jobs and earnings fall and so on. So let me now bring up income after housing costs have been deducted. So after rent and mortgage interest payments have been deducted. What we see here is that median AHC income actually follows a similar pattern to BHC income, just of course it's lower across the board. And keeping that in mind, I now just want to note that we're now going to focus on AHC income. And this is because we're going to be comparing income trends for different kind of groups. For example, the young and the poor, and young and old, and the poor and the rich. And when we're comparing incomes of these certain groups, we're actually, these groups are affected very differentially by housing costs. So we think it's better to look at the AHC income measure, especially if we're looking at the period prior to the financial crisis, given that that was a time where mortgage interest rates really fell quite substantially. So I'm showing you the same as before, here AHC income overall, but let's now look at how the young have fared versus the old. What we see is that in the period leading up to the recession, the income of those aged 60 and above measured after housing costs was much lower than those for those aged less than 60. However, since around 2009, they followed much more similar patterns, and in fact, no growth in income over the last 2 years of the data is true for young and old alike. So what we're now going to do is look at income growth across the distribution. So now I'm showing you the median again, but this time I'm showing you real growth since 2007. So the median is the 50th percentile, that's the income required to have an income higher than 50% of the population, but lower than the rest. Now, let's look at what's been happening to incomes of low incomes. So now we're looking at the 10th percentile. That's the income needed to have an income higher than 10% of the population, but lower than 90% of the population. And what we see is that income at the 10th percentile actually performed a bit better in the period after immediate aftermath of the financial crisis. In most recent years, it's really fared much worse. So we've seen 3 years basically of no income growth at the median, but we've seen 5 years of no income growth at the 10th percentile. So income at the 10th percentile in 2018 was more or less at the same level it was in 2013. So how have the higher incomes been performing? What I'm showing you here now is the 90th percentile. So that's the income needed to have an income higher than 90% of the population, but lower than 10% of the population. And what we see is that in the immediate aftermath of the financial crisis, the incomes of the 90th percentile were kind of hit harder than low incomes. However, they've really recovered quite nicely and seen reasonable growth since 2012. So this picture really just makes clear that higher incomes have kind of outpaced lower incomes in most recent years. Now we're going to look at how these translate into changes in poverty. But first, let me explain how we measure poverty. We focus on income poverty, which can be measured before or after housing costs have been deducted. We focus here on AHC income poverty. The two measures we're going to touch upon, firstly, absolute poverty, which measures the proportion of individuals who have a household income below a fixed poverty line, here following the government definition of 60% of median 2010 income, which was approximately £13,200 in 2018 prices for a childless couple. The second measure we're going to look at is relative poverty, which measures the proportion of individuals who have an income lower than 60% of contemporary median income, which was £13,900 for a childless couple in 2018. So let's now look at trends in absolute poverty rate since 2007. What I'm showing you here is actually essentially just a very boring graph. We don't see much movement in the absolute poverty rate by demographic groups at all. In 2018, overall, the absolute poverty rate was 20%, after having not changed over the last 2 years and after having fallen slightly in the preceding 3 years. Now, the fact that we don't see much movement in these lines is actually quite disappointing by historical standards, because absolute poverty rates have actually really tended to fall quite sharply. So if I were to draw this graph for previous kind of decades, it would look much more exciting. So let me demonstrate this by showing you now the percentage point change in absolute poverty rate over 8-year periods. What we see here is that in the 60s, 70s, 90s, and 2000s, the absolute poverty rate actually fell by around 5 to 6 percentage points. In the 80s, it fell to a lesser extent of 3 percentage points. However, over the last 8 years of the data, it only fell by a disappointing 1.4 percentage points. Now, trends in relative poverty rate have been quite similar. One thing I just kind of want to highlight is that the relative child poverty rate has now seen the largest sustained increase since the 90s. So what's been driving income growth is overall and across the distribution? What I'm showing you here now is mean income growth overall. So mean income growth overall over the last 2 years of the data was 1%. Now this is lower than what I said before, because we're now looking at mean income growth and not median income growth. The coloured bars here now show you to what extent different income components have contributed to overall growth. And we see that net employment earnings have really pushed up mean income growth, whereas working age benefits and tax credits have really pulled down mean income growth. And this is because we saw a continued freeze to most working age benefits and tax credits in 2017-18, which basically means that their real value was eroded as inflation rose. However, they won't have fallen only because of that, but also because of the growth in employment earnings, which of course means that entitlements to means tested benefits will have decreased. So one thing that this graph makes clear is that looking at mean income growth really hides differences across the distribution. If we focus on the middle here, we see that the stalling of mean income growth is largely explained by the stalling of mean employment earnings for this group. However, in contrast, if we look at the poorest fifth of households on the left-hand side or the richest fifth of households on the right-hand side, we see that net employment earnings really pushed up mean income growth for both. However, we also see through the dark green bar that working age benefits really push down mean income growth for the lowest income fifth of the population, but not so much for the highest income fifth. And this is because the lowest income fifth of the population actually see around a third of their income coming from working age benefits and tax credits, whereas the highest income fifth only sees 1% of their income coming from that source. So we've now looked at kind of recent trends, but prior to the onset of the coronavirus crisis, both in incomes and in poverty. What we of course don't know much about is how these are going to change in the future, because the future at the moment is extremely uncertain. However, what we do know is that unfortunately, in a cruel twist of fate, it's actually those workers who are most likely to see a fall in their earnings or to lose their jobs completely due to the coronavirus pandemic, who were actually already doing quite badly prior to the onset of the coronavirus crisis. And I'm going to demonstrate this through this graph. So the relative poverty rate amongst all employees was around 11%. If we look at now the poverty rate amongst employees in shutdown sectors, and that's employees working, for example, in non-food, non-pharmaceutical retail or in hospitality versus employees in other sectors, we see that employees in shutdown sectors were almost twice as likely to be in relative poverty prior to the onset of the coronavirus pandemic than employees in other sectors were. If we now look at relative rates amongst those employees who can easily work from home, for example, people working in finance, or employees who cannot easily work from home, for example, hairdressers, we see that employees who can't easily work from home were again much more likely to be in relative poverty prior to the onset of the crisis than employees who can easily work from home. So of course, this is all quite worrisome, given that these are the people who we really think are going to see earnings falls and perhaps also lose their jobs entirely, or are more likely to. Now, of course, when we're thinking about people losing their jobs and thinking about how the government will be supporting these individuals, it's important to look at benefit entitlements for workless people. So now I'm looking at benefit entitlements among workless households. The dark green bars are showing you benefit entitlements for different kinds of workless households in 2020 if we hadn't seen any temporary increases in benefit entitlements due to the coronavirus pandemic. Now, these temporary increases I'm talking about are the increase in housing benefits and the temporary increase to basic allowance in UC. The light green bar then shows you that entitlements have been topped up through these temporary increases somewhat. However, what I'm going to show you now is that the cuts since 2011-12 that we've seen to benefit entitlements among workless households have been much larger than the temporary increases that we've seen now due to the coronavirus pandemic. So to put this in kind of monetary terms, we see that over all workless households, if we hadn't seen any cuts since 2011-12, so for example, no benefits freeze and no cut to tax credits, these kind of workless households would have had £1,600 more income from benefit entitlements. Amongst workless households with children, this rises to £2,900 benefit entitlements lost due to the cuts since 2011-12, and that's in yearly terms. So let me summarize. The coronavirus pandemic hit at a time where we're still paying the price of the long hangover from the last recession. We've seen years of low earnings growth, we've seen a pared-back benefit system, and we've seen disappointing income growth and poverty trends. For example, we've seen no median income growth for 3 years and no income growth for the 10th percentile for 5 years. Furthermore, we've seen really disappointing reduction in the absolute poverty rate over the last decade or so. It's also important to note that those who look most at risk during the pandemic were already doing quite poorly. So this all underlines the crucial importance of avoiding such severe persistent effects as we bounce back from this recession. And one thing we do know from the past recession is that employment growth was really key to the recovery after a financial crisis. And this is something that Tom Waters is now going to talk about in his presentation. So I'm now going to hand over to him. Thank you.
Hi, thanks very much, Pascal. So as Pascal said, I'm going to be looking at the labour market, and specifically going to be looking at it over this period from the Great Recession, from just before the Great Recession, 2007, up until the eve of the current crisis. I think it's helpful when we're thinking about the recovery from the current crisis to see what lessons we can learn when we look at the recovery from the last one. Okay, so kicking off with the big picture. When we look at the overall employment rate for 25 to 64-year-olds, who we're going to be focusing on in this presentation, we see that employment fell a bit in the recession and then recovered fairly strongly afterwards to leave employment at the employment rate at its highest level ever. Now, what's behind this growth? Well, about 15% of it can be explained by two specific policies. So the lone parent obligation, which required more lone parents out of work to search for jobs if they wanted to claim out of work benefits, and the raising of the female state pension age. Over the period, we also saw the population become better educated. That might have contributed towards the rising employment rate as well. It's hard to say exactly how much, but actually at the same time, changes in the population with regard to things like age and ethnicity and family structure, those actually push down on the employment rate. But another just important point to keep in mind is that a lot of this is a longer running secular trend. You see here, there's just a long running increase in female employment, which goes back beyond the start of this graph, which continued after the recession. Okay, so where was this increase in employment seen in the income distribution? So what I'm doing here is I'm ranking households from the poorest on the left to the richest on the right, and looking at the employment rate of 25 to 64-year-olds in those households. And so you can see at the moment what it looked like in 2007, with, not surprisingly, higher income households being more likely to have people in work than lower income ones. If we zoom forward to 2018, there's a couple of things to note. The first is that the employment rates increased across the board, across all of these income deciles. But secondly, the size of those changes, if I put this line on to show the magnitude of the changes, were largest in the second and third decile of really pretty significant changes of about 10 percentage points. And the second and third decile, those are people who are in poverty or around the poverty line. And so the growth in employment that we've seen is therefore to a significant extent a poverty issue. So the quality and the nature of these jobs disproportionately affect those who are in or around the poverty line. Okay, so that shows where employment came in terms of the income distribution. Let's look now at demographic groups. So there's quite a lot going on in this chart. I'm showing the employment rates in 2007 and 2019 for quite a few different employment demographic groups. And I want to just draw your attention to three key things. So the first is that employment has grown in all of these groups that we're looking at. Secondly, when we look at where growth has been fastest, we in general see that it's been fastest for those groups that had lower employment rates to begin with. So for example, women, immigrants and single parents have all seen pretty significant increases in employment rates. That's also broadly true when we look at things at the regional level. It tends to be that lower employment regions saw a faster growth than those that already had a higher employment rate. Now, given that, you might worry that these fast-growing groups are kind of hiding deteriorating labour market outcomes for more narrowly defined groups. But one way of getting a handle on that is to look at those who don't fall into any of these fast-growing groups. So specifically, we look at non-immigrant men who live outside of London, and for them, we don't see any fall in their employment rate. In fact, actually, we see a slight increase. So it doesn't appear that these fast increases for some groups are hiding lower employment rates for others. Okay, let's look now at what jobs these people are doing. So here I'm just categorizing people into different industries and showing the number of workers in each of them in 2007 and 2019. So the first thing to note from this is there were perhaps 4 or so sectors that saw really fast increases over the period: accommodation and food services, education, professional activities, and health. And there was one sector that saw a pretty significant decline, that's manufacturing. Now, given that the growth in employment has been focused more in some industries than others, and we know that different industries have been differently affected by the COVID crisis, you might expect the growth in employment that we saw over this 12-year period to have changed how exposed the workforce is to the current coronavirus pandemic. So that's what we want to look at now. So there's several ways in which the workforce can be exposed to the coronavirus pandemic in terms of their job being exposed. So the first is whether or not you can work from home. And what we find interestingly is that all of the growth in employment over this period can be accounted for by jobs that can be done from home. Now that's a consequence of some offsetting changes. You saw on the previous slide more people working in accommodation and food services, which is a job that typically can't be done from home. But there was also fewer people working in manufacturing, another job that can't be done from home. And so overall, the entirety of the growth that we did see can be accounted for by jobs that can be done at home. So that kind of protected the workforce from the coronavirus pandemic. But that's not the only way that COVID can affect the labour market. Another important way is through industries that have been shut down, we should see that there's no or very little overall change in the share of the workforce that are in shutdown industries. But another way that the pandemic might affect the labour market is through childcare, because of schools and childcare services largely being closed. And what we find actually is that over the period from 2007 to 2019, we saw an increase in the share of workers with childcare responsibilities. So that increased their exposure to the coronavirus pandemic. And that's a consequence of largely of more parents getting into work. And then lastly, we also find that there's been an increase in the share of workers classified as key workers who, of course, were generally expected to keep working through the pandemic. Okay, so far we've been talking about the increase in employment. Now, we might worry that perhaps, given that there's been a sharp increase, but perhaps a lot of these jobs are low quality, or that in some sense the overall level of job quality are deteriorating. So what I'm going to do now to get a bit of a handle on that question is to look at survey data on people's perceptions of their own jobs. And here I'm going to be looking at 2005 and 2015, just because that's when the data is available for. So this is basically a story of kind of two halves. So the positive side of the story are in the categories I put on the screen here. So things like the interest and value in work, relations with managers, colleagues in the firm, and perceptions of progression, all of these have improved from 2005 to 2015. You can see more people saying their job is interesting or contributes to society, more people willing to work hard to help the firm, people saying the opportunities for advancement are high. But then on the other side, we see more people reporting difficulties at work, perhaps surprisingly, more people reporting that their work involves hard physical work. And we see a decline in perceived job security. And also, perhaps surprisingly, we see a decline in people's perceptions of the flexibility of their job. And I think that's these last two things are particularly interesting, because you might typically think that job security and flexibility kind of come at the expense of one another. But at least over this period, what we saw was both of them worsening at the same time. Now, because of limitations in sample size, it's difficult for us to investigate different subgroups. But insofar as we can, it appears that the difficulties at work worsening is driven almost entirely by those in the bottom half of the earnings distribution, while the improvement in interest and value of work was more concentrated among women. Okay, so that's people's perception of the quality of their job. Another natural thing to look at is their pay. So just as we might be concerned about job quality in terms of the characteristics just mentioned, we also might be concerned about trends in pay. So here we're looking at how wages have changed across the distribution, hourly wages, I should say, between 2007 and 2019. So I think there's three things to take from this chart. The first is that women have done better than men, with almost all of the female wage distribution rising and almost all of the male wage distribution falling. And we've also seen stronger growth at the bottom of the distribution than at the middle or top, partly in thanks to the national living wage. But overall, the patterns that we see here have been very weak. So in real terms, median hourly wages around here are about 2%, were in 2019 about 2% below where they were back in 2007. And just to give you kind of a handle on that in historical terms, if we look at the decade before the Great Recession, median hourly wages grew by 24%, which wouldn't even actually make it onto this graph. So pay has certainly been really very weak over this period. Okay, bringing everything together. So employment growth over the period between these two crises clearly was very strong, and that was especially true for poor households. And this growth came at a time when other labour market outcomes had been more mixed. So we saw with job quality some improvements in things like interest in work, but also worsening in things like flexibility and security, or where some labour market outcomes have actually been quite poor in the case of pay, with real hourly wages actually slightly falling over the period. So looking to today with the current crisis, what that shows is that the current crisis, which has put a lot of pressure on employment, has really undercut the one thing that was holding poverty down. So as we look forward into the recovery from the current crisis and beyond that, the challenge is for poverty is to get back to where we were before COVID, and the challenge of doing that is just layered on top of the already existing issues of poor pay and insecurity. So I'm going to hand back over now to Paul to take some of these questions.
Well, thank you very much indeed, Tom and Pascal. We've got a number of questions that have come in over the last half an hour or so. And if you have others, please, as I say, do email them to events@ifs.org.uk. Let's start with a very polite question here. It says, can you kindly say more about child poverty, please? Which may well be in the context of some of the rows that have been going on in Parliament about what has and hasn't been happening to child poverty. Perhaps Pascal, you could kick off on that, and then maybe Rob might want to come in as well.
Yeah, sure. So I think I mentioned very briefly in the presentation that we've actually, so relative poverty has increased by 3 percentage points since 2011-12. That's actually the most sustained rise in relative poverty that we've seen since the 90s. Now, this is due to kind of two things. It's due to rises between 2011 and 2016, but then a stalling between 2016 and 18. The absolute poverty, absolute child poverty rate, has actually decreased slightly by around 1 percentage point since 2010-11.
Great, thank you. Did you want to add anything to that, Rob?
Not really. I mean, other than, of course, this often happens from time to time in political back and forth, is that there are different poverty statistics, and different ones can get used to make slightly different points. But I think the big picture is fairly clear, and is the one that I think came from what Pascal just said, which is that if you compare this to most periods, certainly in recent history, we've seen very, very poor improvements in living standards at the bottom, particularly for families with children. And of course, a lot of that has to do with the last 10 years of benefit cuts as well, because low-income families are a group that have been most affected by that.
But just to repeat so that people are clear, Pascal, I think you said that relative poverty since 2011 has risen for children, and reasonably significantly by historical standards. Absolute poverty has fallen very slightly, but that is a remarkably small amount by historical standards, because absolute poverty tends to fall at a reasonable rate over time. Is that a fair summary?
That's a fair summary, yeah.
Excellent. So I think we've got that one. So some other questions. Can we say anything about what differences have occurred in different parts of the country? Can we say anything about regional differences in changes in living standards or inequality? And again, this is obviously a particularly topical issue, given that the levelling up agenda is one of the few things that seems to have survived the recent crisis. Do you want to try that one, Rob?
Sorry, I wasn't sure who was going to answer. Yeah, so there's a few things to say, perhaps. I mean, one is that, I mean, the regional picture, taken literally to mean the broad regions of England and the nations of the UK, which is typically what it means, is that's important, but actually masks a lot of other variation. You see a lot of differences, both certainly in levels of living standards, within regions, actually often within quite small areas of the country, just between different localities. At a broad regional level, there's a couple of things. I mean, the employment trends that Tom talked about, they've been pretty widespread across regions in terms of the growth in the period between the last crisis and this one. In terms of broad regions, everywhere saw a fair bit of employment growth. In terms of living standards, again, at the broad regional level, the differences are not that massive. There is, London has pulled away a bit in recent history from the rest of the country, has pulled away a little bit further. But again, a lot of the differences, I think a lot of the more interesting differences here are actually at a somewhat more local level than at the level of broad regions. And of course, over the very long term, we've seen, really very big changes in the relative economic well-being of certain kinds of localities, wherever they are, like, for example, coastal towns. And there's a lot of concern about that kind of geographic inequality as well as the broader regional inequality.
Yeah, I think it's fair to say that the last decade has not seen actually a big increase in regional inequality, but it has seen what one might call a consolidation of the inequalities between regions we've seen over time. But it is important to be clear that when we're looking at income inequality across the UK, most of that is within regions, it's not between regions. It is the case that the very highest earners are quite concentrated in a small number of relatively small areas, bits of central London, some of the home counties. The very highest earners tend to be concentrated there. But actually you do tend to get low income people right across the country. I think that's the big difference in many ways between the what we often think of as the well-off regions and the less well-off regions. It's not so much that there are no poor people in the well-off regions, it's that there are very few very rich people in the less well-off regions. There's a couple of questions here about education. So one question is about the extent to which education can reduce poverty. Do low-income earners manage to get better paying jobs if they become well educated, or do they just remain overqualified in the same sorts of jobs? Is that something that anyone would like to have a go at? It's particularly, I think, important in the current context where we may be thinking about using education and training as a way of dealing with the very specific problems in the labour market that we face at the moment.
Yeah, I don't mind coming in on that one, Paul. So in general, we do believe that retraining and education policy, if done correctly and with a sort of keen eye on the sectors of the economy that are really growing and which need new workers and which offer relatively high paying jobs, if policies such as education and retraining can really target the skills that they equip workers with towards those growing sectors, we generally think that those sorts of retraining policies will help increase earnings and move workers either from low paying sectors into high paying sectors or from unemployment into employment. But that said, that's quite a hard thing to do in practice, and it really does need to be done carefully. It's not sort of good enough to just say we're going to do education, we're going to do retraining. If that's not done with the sufficient degree of focus that is required for those policies to be successful, then that perhaps you might exactly just end up with a situation where people go through the retraining programs but come out the other end and see that the skills they've acquired just aren't required by the labour market, and so then they are just ending up perhaps in the same low paying job they were doing before.
I think that point that Agnes makes about the variability in the success of some of these different forms of educational training is really important. I mean, in the case of training, I think it's the case that generally where you have very large scale kind of blanket sort of classroom based training that isn't particularly linked to a firm or a specific kind of occupational qualification, that the returns from that can tend to be very, very, very weak indeed. And that more targeted things tend to have a bit of a better rep, I think for good reason. And you see this in other areas. And if you look at the higher education sector specifically as well, and there are colleagues we have who will be able to talk more fully about this, but they've done work looking at the financial returns to different forms of higher education at different places in different subjects. They vary very, 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 very widely indeed.
Yes, the one of the puzzles actually about the last decade, in a sense, is that the population has become better educated at a very high rate. The numbers of graduates coming into the labour market has been very big, and actually, as it were, those who are retiring at the other end are almost the last generation of relatively small numbers of graduates. And yet, over this period, when the workforce has become, in principle, much more highly educated, we've had the worst decade for earnings growth pretty much in history. And this, as Rob was suggesting, is at least one of the aspects that is likely to be related to, is the relationship between the kinds of education that people are receiving and the kinds of skills that are needed. The questions are coming in thick and fast. There's one here which I think is really quite important. It's about measures of material deprivation and how they relate to measures of poverty. And that's something that I recall we looked at in some detail in the annual report last year, where I'm sure one of my colleagues will correct me if I'm getting this wrong, but my recollection is that the measures of material deprivation were falling, in the sense that would indicate that the poorest groups were, in some senses at least, getting better off at a rate that wasn't captured by the income poverty measures that we were looking at. But which one of you would like to come in on that?
Yeah, I can talk about that. Yeah, so certainly, when we looked at it last year, it looked like when we look at material deprivation measures, they were improving pretty significantly, and they're improving kind of for people at different points of the income distribution and in different kind of dimensions, if you like, of material deprivation. So for those you don't know, the way material deprivation is measured is households are asked whether they feel they're able to afford a range of basic goods. And that might be things like being able to keep their home warm, or being able to replace broken furniture, things like that. And across the board, we saw an improvement in all of those measures, which was certainly better than what was going on in terms of absolute poverty. I think both of these kind of more income-based measures like absolute poverty and these other measures like material deprivation, they all kind of tell us the different part of the story, and so it might suggest that some of what's going on is that some of the kind of the costs of kind of affording these basic items, perhaps in some cases might have been falling, meaning that even when people's incomes aren't increasing at a great rate, it's easier for them to afford these kinds of goods and services.
I mean, do we have any other theories as to why these things might have been moving in different directions? Because it is something that is quite striking in the analysis that we've produced. So one theory there, Tom, is that the costs of some of these necessities has fallen in relative terms. Any others, or is that our key theory?
That is certainly the one that I remember off the top of my head from last year.
Fine.
But we did actually find some evidence that was the case when you actually look at the indices for prices of these goods. It did look like on the whole, they were, in some cases, prices were actually falling, or at least not rising as much as general inflation.
Okay.
I think it's obviously a very important question as to why those things are trending differently, which, as has probably come out there, we don't fully understand the answer, and it would be good to. I think just to point out on this, the other area where I do think material deprivation figures are really very useful in some cases is just in the cross section, forgetting about time trends. If you're thinking about different groups and how they compare to each other, it can highlight cases where, for example, you've got a group who have low incomes, but for various reasons that doesn't translate through into very low living standards. So a group who are likely to be temporarily poor, for example, or have assets to fall back on. And conversely, there are groups who don't look so badly off on an income basis, but actually can look worse off on a material deprivation basis. And that can highlight things like maybe we've failed to adequately adjust for the family size and the costs of of raising children, or of being in a certain kind of household, for example. These are things that the income measures try to account for, but may not fully do so. And you do see some very important differences there between the income and material deprivation measures, which can, I think, be quite a useful corrective to some of the things that income measures on their own might get a bit wrong, or might be a bit misleading on when we're thinking about living standards.
From recollection, I think we find, don't we, that those who are with disabilities and lone parents look worse off on material deprivation relative to how they look on incomes, whereas often pensioners or those who are owner-occupiers can look better off in terms of material deprivation they do on income measures. So you can see why the material deprivation measures might be capturing, as Rob said, something more about the long-term nature of the low income that people may be, or low living standards that people may be facing. We've got another question here which is asking us to speculate. It's really about what might happen to child poverty rates this year and in the future. In the past, we've made some projections about what might happen to child poverty. For example, looking at the impact of the 4-year benefit freeze, but given that often in recessions relative poverty sometimes falls, what might we think might happen to child poverty this time round? Rob, do you want to kick off on that one?
Sure, I can start. Yeah, I mean, obviously any kind of precise idea at this point is very difficult, but one thing that will matter a lot is whether we're talking about the absolute living standards of these families, or how they're faring relative to those around the middle, which is what the relative poverty measures would pick up. I mean, in absolute terms, obviously, pretty much any group at the moment is under a lot of pressure. So the figures, particularly and certainly in the short term on absolute poverty, are likely to be very, very concerning. If indeed we can get meaningful figures for this year. Obviously, it's kind of difficult to collect data at the moment, but that feels fairly clear. We know that families with children are certainly among those who have been experiencing job losses and plenty of furloughing. They would have been helped in some cases quite a bit by the temporary benefit measures, but as Pascal showed, actually in the context of all the benefit cuts that particularly that group have experienced over the last decade, that's actually only a very small fraction of those being unwound, and even there only temporarily. So then going forward, of course, it all depends, and this might relate to a bigger question that I think we might have coming up actually. Of course, so much depends on what happens to the economy and how that affects different groups coming out of the crisis. So perhaps we'll come on to that. But I mean, in the short term, you're going to see certainly a lot of pressure on absolute poverty. For relative poverty, it's always a bit less clear. We do know that lower earning families seem to be more likely to be suffering from the immediate labour market effects of what's happening right now, which would point towards, even on a relative measure, things deteriorating. But that's thinking about their earnings only. When you think about the total income, it's actually a lot less clear, because one thing that the benefit system does, even though it's been cut back, is it does provide a lot of income protection at the bottom, and more so as a proportion of sort of lost earnings than it does for those further up who lose their job. So the income picture, I think, will be a lot flatter than the earnings picture right now. So it's not so clear, I think, what direction the relative measures will go in.
Any further to add? Well, let's move on to there's a question here about benefits. So the report is quite interesting in really pinning the blame on cuts in benefits for the reduction in incomes for people towards the bottom, particularly over the last 4 or 5 years, which is a really striking pattern. There's a question here about the extent to which that's driven by the move on to universal credit, or to what extent it's different from those who are still on legacy benefits. But I think there's a more general question here, which is, what are the changes to the benefit system which have resulted in this overall reduction in generosity at the bottom? Who'd like to take that?
Yeah, I can talk about Yeah, so universal credit is a bit of a tricky one in the sense that overall, as far as we can tell at the moment, it's not fully rolled out yet. It will probably cost the government roughly the same amount as the system it's replacing. So it's not overall a cut or a giveaway, or if it is, it's only a roughly small amount in one direction or the other. So the more significant benefit changes that have come in that affect poorer families, one would certainly be the benefits freeze, which has already been mentioned. So for 4 years, most working age benefits didn't rise in nominal terms, whilst prices went up by about 6.5% or something. And before that, the benefits were only going up by 1%, whilst inflation was often higher than that. And another couple of important ones would be cuts to tax credits. And so in particular, one that affects larger families is the so-called two-child limit, which means that child tax credit, which is a means-tested benefit for poor families with children, it used to be that you get an extra amount, about £2,800 each year for every child that you have. That now is capped at the first 2 children. And so that it affects a relatively small number of families. I mean, still in the hundreds of thousands, but a relatively small number, but it affects them to a very large extent, and so it causes a pretty significant cut to their incomes. So I would probably point to those as being some of the most important benefit cuts over the period.
Do we know how well targeted the 2 big increases that we've seen this year are a £1,000 increase in the standard rate of universal credit and a significant change to local housing allowance? Can you say a little bit about the impact that they may have on incomes and the distribution of income?
I can quickly, just on this point, I think, and also to before, I wanted to add on that the graph that I showed you right at the end, showing benefit entitlements 2020 with and without increases, actually kind of over, let's say, estimated the amount of temporary measures, given that the graph I showed you was considering that or assuming that all people were on UC. So actually, if anything, the temporary measures that I showed you would have been actually even smaller relative to the benefit cuts that we'd seen since 2011.
Tom, do you want to say something about the UC and LHA changes we've seen this year?
Yeah, okay. So I guess in broad terms, you think these are certainly going to affect poorer families. These are means tested benefits, which are targeted at roughly people who, in general, people who are towards the bottom end of the income distribution. The increase to local housing allowance that Paul mentioned, what that does is, if you're a private renter, there's a maximum amount of rent that you can get covered by housing benefit or its equivalent in universal credit, and that those amounts have been raised. Now, the effect that has is it actually kind of it equalizes a situation that had been becoming increasingly unequal for a number of years, where it's now the case that you can get your rent covered up to the 30th percentile of rents in your local area. So if you rent a property that's in the bottom third or so of rents, then you can get your whole rent covered. Before that, the system had been moved about in particular ways that meant that wasn't the case, and in some areas people would be much more likely to get all their rent covered than in other areas. So that helps private renters, particularly private renters and things in places like London and Cambridge. And then the increase to universal credit, I mean, that's sort of a flat increase, and it helps anyone that's on UC. I guess because it's just a flat £1,000 a year to everyone, it's going to have a proportionally bigger effect on smaller families than it does on larger families who tend to get more benefits.
Great. I think we've got time probably for one more question. There's a question here about tax thresholds. So clearly a big part of the government's agenda from 2010 onwards was to increase the income tax threshold. And indeed, it's moved it up very sharply to £12,500. What impact has that had on measures of living standards, poverty and inequality? Rob?
Yeah, well, it's a good question because it comes to a broader point about the kinds of targeting you can do by changing income tax relative actually to, for example, to benefits. So with an income tax cut, like the reduction in the personal allowance, that's almost as progressive an income tax cut as you can do, because you're taking out the people right at the bottom amongst those who are currently paying any income tax. You're cutting their tax bill. But nevertheless, if you actually look at where the gains go by household income, not by just individual income amongst individual income taxpayers, they go to the middle or even upper middle of the household income distribution. And that's just because the relationship between who's the lowest income taxpayer and who's the lowest income person by a measure of household income is very weak. You've got people who benefit from this, who live with really quite high income partners. You've got people, a lot of people now at the bottom of the individual income distribution who don't pay income tax anyway. So they're not benefiting. So they're not the people at the bottom of the household income distribution typically. There's about 40% now of people who actually, in terms of their personal income, they simply don't pay any income tax. So further increases in the threshold don't help them at all. And of course, two earner couples often will gain twice as well from an income tax cut. So again, when you're looking at by household income, a measure like that is much less progressive than if you're looking at what's the effect amongst individuals on their individual income amongst those who pay income tax. So that's the broad answer. So something like that, there are still reasons why you might want to do it, of course, but it's really not well targeted at low-income households.
Brilliant. Thank you very much. I think we are basically at the end of our allotted time now. There's quite a lot of other things that we could say and answer here, but I think we'll stop the webinar at this point. Thank you to everyone for listening. Thank you to Rob, Agnes, Pascal, and Tom for doing all the work, putting together another fantastic report, which you can see, of course, on our website, where you can also see the huge amount of work we've been doing around the coronavirus episode at the moment. Do look out particularly for all of the work that we're doing as part of the Nuffield Foundation funded Deaton review of inequalities, which will be digging into a lot of these issues around inequality and living standards in much more depth over the coming months and years. So thank you very much, everyone, for coming along and watching this event. Hopefully, next year, we will be back live and presenting this to a live audience, but we will certainly be back next year with the 30th or 31st annual update of our work on incomes and living standards. So thank you very much. Have a good day, and we'll see you soon.